Catastrophe bonds, better known as cat bonds, are complex insurance-linked securities that traditionally transfer risk against natural disasters such as tornadoes, volcanoes, hurricanes and floods, among others, from sponsors to investors. Cat bonds can provide differentiated risk characteristics from traditional asset classes, as well as potential diversification benefits to investors' portfolios. New issuance of cat bonds hit record levels in 2021, but as climate concerns and the ongoing pandemic continue to impact the world and thereby the cat bond landscape, what might investors want to take into consideration? My name is Anu Rajakumar, and today I'm joined in the New York studio by Cedric Dree, a managing director, and Sophie Ware, a senior vice president who's based in London, on our insurance-linked securities team here at Neuberger Berman, to shed light on how cat bonds operate and thrive today. Cedric, Sophie, thank you very much for joining me.
Great to be here.
Thanks for having us.
So as I mentioned in the opening, cat bonds can be considered a niche, complex type of a bond. So maybe we can start by giving our listeners a better understanding of how they work. What is a catastrophe bond, and what are some of the characteristics that investors should be aware of when considering them in an investment portfolio?
Sure, I'm happy to start with that. So catastrophe bonds, they can sometimes be seen as complex or daunting, but in their very basic form, there's a simple way to transfer natural catastrophe risk, think hurricanes, earthquake, floods, or even tornado risk, from a protection buyer, who's typically an insurance company, but can also be a corporate or even local and government entities, to protection sellers who take on that risk in exchange for a fixed income type of return. Typically over a period of 3 to 4 years. From a technical standpoint, they're most often 144A fixed income securities, which means that they're offered for purchase to qualified investment buyers, such as pension funds or specialized investment funds like ourselves. Overall, it's an asset class that's grown tremendously from its humble beginnings, which date back to the mid to late 90s, to what we're seeing today, where we see approximately 200 catastrophe bonds currently in the market, and they total just over 30 billion in notional limit. Sophie, perhaps, did you want to take us through a few interesting examples and specifics?
Thanks, Cedric. Sure. Maybe I can add a little bit of colour onto who issues cat bonds and why. So as Cedric mentioned, cat bonds can cover a range of natural catastrophe events. And although US wind and earthquake are typically the most common risks covered, simply because these are the events that have the potential to result in the largest insured losses, as the market continues to develop, and particularly as new sponsors look to issue cat bonds, we are seeing new types of perils and regions come to market. So, for example, in the first half of this year, an Italian regional insurer issued a bond which included Italian earthquake risk, and also the World Bank issued a bond to cover Jamaica against hurricanes. The most prolific issuers of cat bonds are still the insurance and reinsurance companies looking to transfer some of their risks off balance sheet into the capital market. This includes some of the big national insurers, including household names like USAA and Allstate. But increasingly, we're seeing new types of sponsors enter the market. Actually, in 2020, we had 10 new sponsors come to market, and this year, 7 already. I think one of the most interesting types of new entrants has been the corporate entities. So last year, Alphabet came to the market with a bond to cover their corporate real estate assets against earthquake risk in California. Other examples we've seen have been the energy company Sempra, who came to market last year with a bond looking to protect them against losses from wildfire, where they're found liable due to faulty equipment. In a similar vein, over the course of the market's life, we've seen a number of transportation-related deals. I think the most interesting of these is the New York MTA, who come to market looking to protect against losses arising from flooding or earthquake impacting the network. I think we'll continue to see issuance growth here, as many entities have potential exposure to losses resulting from natural catastrophes.
Yeah, thanks, Sophie. And very interesting to see how the cat bond space is evolving, and very timely that you mentioned the New York MTA also getting the space, given that Hurricane Ida just ravaged the city fairly recently. Would love it if you could just take a moment to compare and contrast cat bonds to traditional fixed income assets, and also maybe just touch on how cat bonds can be structured to avoid losses.
Sure. The key feature that makes cat bond an attractive investment is their low correlation to global financial markets. Obviously, events occurring when we talk about hurricanes and earthquake just aren't related to global financial events. So we really want to focus on that natural event risk premium. And as a result, the other types of risk are typically mitigated through the use, for example, of a fully collateralized trust to hold the funds, which removes or at least avoids most of the credit and counterparty risk, so that we focus on that natural event risk only. I'll probably let Sophie in a little bit go into more detail on how investors think about cat bonds, how they allocate them to their portfolio, and can take you through the risk side first on how we analyze and think about that risk. Since we mentioned their risk transfer instruments, the natural underlying event risk must be analyzed, and that's typically done through the use of specialized catastrophe modeling software as well as simulation tools, not just historical events. What we're trying to do here is really stress test our assumptions such that we go beyond the historical record and really analyze the potential for large extreme events. We need to be able to quantify the probability of those bonds attaching and calculate the expected value of potential impairments or payout if qualified events were to occur. So as an example, one would compute the probability of a hurricane causing $100 billion in insured losses to the state of Florida, or instead just focus on the county of Miami-Dade and quantify the probability of a $5 billion event occurring, but only in that specific region. And that goes to show that cat bonds can cover both a large number of perils and region, but also geographic areas that can be broad as well as narrowly defined. There's really an embedded diversification potential in cat bonds that's very attractive in addition to their uncorrelated risk nature.
I think this market has an appealing profile to investors for quite a few reasons. Cat bonds should provide investors with a relatively consistent return profile over time in the absence of major natural catastrophe events, and also with a differentiated return profile from other asset classes, as Cedric mentioned, given they're capturing a natural event risk premium. It's important to note that, unlike in other segments of the reinsurance market, cat bonds have the advantage that they're also liquid and tradable. Spreads paid by cedents to issue cat bonds actually look pretty competitive, given the cedents need to hedge major catastrophe risks on their balance sheets, and as a result compare very favourably to corporate bonds. For example, the current weighted average spread in what we define as the cat bond universe is in excess of 6.5%, and that compares very favourably to corporate high yield. Cat bonds are also floating rate, which could be an attractive profile in a rising rate environment, because if short-term rates go up, so will overall yield, and that could be quite topical at the moment. Another advantage is that cat bond issued spreads and their risk profile does vary dramatically. You can see issued spreads of anything from 2.5% to 20%, and that allows mandates to be customised depending on risk-reward requirements. I think it's also important to highlight that the current outlook for cat bonds is very compelling in terms of pricing. While other markets seem to have suffered from spread compression due to the global hunt for yield, the cat bond market has actually remained relatively immune from this because of the relatively high barriers to entry. Similar to other segments of the reinsurance market, cat bond pricing is broadly correlated to global insured losses. We've had several recent years of high losses, and already in 2021, as listeners will be aware, we've had the Texas winter storm in February, floods in Europe, and also most recently Hurricane Ida, which after making landfall in Louisiana as a Cat 4 hurricane, then continued inland to the northeast to generate record-breaking rainfall and flooding. It's going to take a little while for initial losses to officially be released for Ida, but I think the event is set to be significantly bigger than any hurricane losses we've seen since 2017, and that should help support cat bond pricing into 2022.
Great. Thank you very much for that, Sophie. Very helpful context, particularly characteristics of catastrophe bonds. Cedric, as you were speaking about catastrophe modeling software and hurricanes in Florida, it did make me think of the ESG link, which is a key topic for investors. What should investors know about catastrophe bonds as it relates to ESG?
Sure, that's a very, very good question. And catastrophe bonds are actually very interesting from an ESG standpoint. I think there's a couple of different layers to it. I think first, on the sponsor side, every time a potential sponsor thinks about natural event risk, it forces them to acknowledge and quantify and assess their environmental and climate exposure, which is obviously a good thing from a governance standpoint. The second thing that it makes me think about is the investor side. When you think of equities or fixed income ESG screens, they're typically screens where you narrow down and filter the type of company you want to invest in. Here, instead, there's a very direct link into the ESG world through your investment because it protects against losses linked to those type of extreme event. So the risk transfer is very direct. capital participants sharing a portion of the claims, and that overall strengthens the global insurance market. What we've seen in the past, most notably after 1992, following Hurricane Andrew, was a number of insurance companies becoming insolvent and unable to pay claims. The fact that cat bond market now exists helps avoid this type of situation. It ultimately adds resilience to the space, and all the way down to the homeowner level, you see a benefit from a more robust system. Without a way to transfer risk out, the cost of insurance would most likely increase. And finally, you also see cat bonds being issued not just in the developed markets, but also in emerging economies, most notably by the World Bank. In those markets, the underlying insurance is not as deep and robust, and cat bond for those emerging economies can provide much needed financial assistance in the immediate aftermath of an event. So that altogether helps address a number of the UN Sustainable Development Goals.
You know, Cedric, that's interesting that you mentioned emerging markets here. Just out of curiosity, which markets specifically have you seen bonds be issued for?
Sure. The World Bank has quite a developed issuance program dating back to 2017. Currently, in terms of outstanding bonds still in the market, there's a bond covering Mexico for storm and earthquake risk, and also the Philippines for wind and earthquake risk as well. Interestingly, they actually came to market this year for the first time to cover Jamaica against hurricane risk. But if you look back historically to other bonds they've issued, which have since matured, you can see that they've covered regions such as Peru, Colombia, Chile, and obviously there's significant scope for further geographies to be added over time.
Yeah, terrific. Thank you very much. Now, just want to speak about cat bonds in the context of asset allocation. Could you talk a little about what cat bonds bring in terms of diversification and how investors allocate to cat bonds, as well as what some of the risks are, other than the unknowable risk of natural disaster?
Sure. The diversification angle here is actually very key and multifaceted, both in terms of the diversification benefits of the asset class versus other risk assets, but also the ability to construct a diversified portfolio within the cat bond universe itself. So one of the reasons why cat bonds have appealed to investors is undoubtedly that they may provide portfolios with a source of diversifying returns. The performance of cat bonds, as we've discussed, is driven by natural catastrophes, such as hurricanes and earthquakes, which are, by definition, uncorrelated to any macro or company level drivers. And therefore, in the medium term, they should demonstrate very low correlation to other risk assets, such as fixed income, equity markets, and also hedge funds. This diversification effect has actually been tested in a number of periods, including during the financial crisis, 2008, 2009, and again at the beginning of the pandemic in 2020, over which the cat bond market remained resilient. We talk about this in more depth in our cat bond white paper, where some comparative performance numbers are also provided. The low correlation to other fixed income markets is undoubtedly helping drive demand for cat bonds from dedicated fixed income players as part of their broader mandates, but also within the more specialized alternative investment buckets, given their low correlation to other hedge fund strategies. And then in terms of intra-asset class diversification, this is also an important consideration. I think it's somewhat a misconception that a single US hurricane or earthquake event will automatically result in a major loss for the strategy. It is in fact possible and indeed desirable to build diversification into a portfolio of cat bonds, and this can be through a number of ways. Typically, we'd think of it in 4 dimensions. So first would be peril type, such as wind, earthquake, fire. Secondly, geographical area, including state and regional exposure within the US, but also non-US exposure, so regions such as Japan and Europe. And it's also possible to diversify by cat bond trigger type and structure. And again, we go into that in a lot more detail about the various types of cat bonds and their payout mechanisms in our white paper. I think the obvious considerations to point out for cat bond investing is that if a covered event occurs, individual cat bonds can pay out up to 100% of principal. This is rare, but it has actually occurred on a number of occasions following large individual events. So following Katrina in 2005, the Fukushima earthquake in Japan in 2011, and somewhat topically, the payout of the World Bank pandemic bond due to COVID-19 in 2020. I think it's, however, important to point out that at the universe level, so if you look at the Swiss Re Cat Bond Index, the performance impact of these events was limited, which speaks to the sort of magnitude of natural catastrophe events that the cat bond market typically underwrites. I think it does, however, point to the need for an element of portfolio diversification rather than, say, investing in one single cat bond, and also the importance of specialised expertise when investing in this market.
Yep, that's terrific, and certainly interesting to hear about diversification within the cat bond space as well. So thank you for sharing that. I mentioned in the opening that new issuance of cat bonds hit record levels in 2021. I'd love to hear, just as we wrap up now, what are your comments on the outlook for cat bonds going forward? Do you foresee that issuance continuing to grow at the same pace? How do you see growth in terms of the global nature of cat bond offerings? Maybe you could just speak a little bit about that and just in general outlook comments.
Sure. We do believe that cat bonds are not only here to stay, but see continued growth in many years to come. First, they still represent a very small fraction of the global insurance market. We mentioned briefly in the opening, cat bonds market still stands at about 30 billion compared to the trillions of insurance capital that's at risk. And overall, the current limitation of insurance coverage are still pretty high, which has a number of perverse effects. It leads to large underinsured market. So, for example, in the state of California, most people still do not have earthquake coverage given the cost of the underlying exposure. And it also leads to underserved market altogether. As we briefly noted, in emerging economies, there are entire regions where there's not sufficient coverage for just about anybody. So we believe that transferring some of the risk out to the global capital market is a very efficient use of capital, allowing the investors who are willing to take on that risk to earn an interesting and largely uncorrelated return stream.
I agree with Cedric that the cat bond market will continue to grow, both as new cedants come to market, but also as we see traditional insurer and reinsurers look increasingly to the capital markets. But while the cat bond market might seem small compared to other asset classes, the total ILS market size is now back at a record 97 billion, and some of this can definitely potentially be redirected into the cat bond market. There are several advantages for sponsors for going that route. We're also currently seeing a lot of demand for regions and perils which are regarded as diversifying away from US wind. So I think we'll see more bonds covering Japan, Europe, Australia, and maybe even more developing countries, as well as potentially newer perils. So the recent floods in Germany is an obvious example of a protection gap. And also, while it's out of our universe, as we focus on natural catastrophe events, cyber and other man-made perils are likely to be a big growth area. Generally, the market growth is very positive for us as investors. It allows increasingly diversified portfolios, but it's also very helpful to create a liquid secondary market for the asset class. And finally, we've already talked about the role of ESG in the cat bond market, but I think this has potential to be a strong growth area as other developing nations and global agencies see the utility of securing disaster financing. For example, in the private bond market, we've already seen a transaction from the Danish Red Cross covering volcanic eruptions, so we know there's a lot of potential demand out there. And another area of growth could be for specific ESG-labelled cat bonds. For example, in June, we saw a €200 million issuance from Generali in Europe, marketed specifically as a green bond, in that the collateral will be invested in assets defined as having a positive environmental impact.
Great. Thank you so much, Cedric and Sophie. Really appreciate your insights into this unique and growing asset class, particularly some of the innovations that we're seeing in the cat bond space. For our listeners, if you're interested in learning more about catastrophe bonds, as Sophie mentioned a couple of times, the team did release a white paper which is available at nb.com. Its name is Catastrophe Bonds, Natural Diversification, and explains what catastrophe bonds are, how they work, etc. So please check that out if you're interested. Once again, Cedric, Sophie, thanks for joining me.
Thank you for having us.
Thank you very much.
And to our listeners, if you like what you've heard today, you can subscribe to the show via Apple Podcast, Google Podcast, or Spotify, or you can visit our website, www.nb.com/disruptive forces, for previous episodes, as well as more information about our firm and offerings.
This podcast contains general market commentary, general investment education, and general information about Neuberger Berman. It is for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. This communication is not directed at any investor or category of investors, and should not be regarded as investment advice or a suggestion to engage in or refrain from any investment-related course of action. All information is current as of the date of recording, and is subject to change without notice. Any views or opinions expressed may not reflect those of the firm as a whole. This material may include estimates, outlooks, projections, and other forward-looking statements. Due to a variety of factors, actual events or market behavior may differ significantly from any views expressed. Please refer to the disclosures contained in the episode notes and episode details, which are an important part of this communication. Investing entails risks, including the possible loss of principal. Past performance is no guarantee of future results.